Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets.
Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. In this week's episode, we're going to briefly touch on September's inflation data. The recent data release comes at a critical juncture. The Canadian economy is slowing, unemployment rate is rising, the lack of visibility on trade continues to hurt business sentiment and investment, and Canada remains mired in a productivity emergency after years of government's efforts to stifle non-residential capex and foreign capital investment. Higher inflation is what we expect will materialize over the next few quarters, and this will complicate life for the BOC, which is shifting its focus from its inflation mandate to supporting growth. But of course, we could be wrong about that, and there's a lack of evidence that inflation is in fact cooling. And in this week's episode, we're going to go over that data too. So let's get into it. The Consumer Price Index, or CPI, rose 2.4% on a year-over-year basis in September, up from a 1.9% increase in August. When looking at economic data, market expectations versus the actual number is really what's noteworthy here, and in September, inflation rose more than expected. Ex-energy, inflation rose at a slightly faster pace of 2.7%, and this means that most of the acceleration in year-over-year CPI growth came from a smaller decline in energy prices in September than in August, negative 2.6% year-over-year versus negative 8.3%. And this moderation proved sufficient to push headline inflation higher. A look at the year-on-year figures, and we can see that food is solidly at the top of the table at 3.8%. This is followed by services inflation at 3% and healthcare at 2.6%. Food costs continued their gradual ascent, rising to 3.8% from 3.4% in August, and this was due primarily to the accelerating grocery prices we're seeing all over Canada. Canada imports a lot of food, and it seems like a much weaker loonie is starting to bite. This is not good for lower-income households that spend a larger proportion of their consumer basket on necessities like food. Shelter, the largest chunk of the consumer basket, is also something we've highlighted many times before, and it remained steady in September at 2.6%. The bars in the lower panel show the contribution to core, and as you can see, these figures have normalized after COVID, but they remain elevated at 1%. However, a breakdown of shelter into its components gives us pause. Ownership costs at 2.1% continue to fall with lower mortgage renewal rates. Meanwhile, household operations, a small weight, is rising apace. Where we have an issue is with the rents. This is also the first piece of evidence that inflation may not be as strong as the headline figures suggest. According to the CPI release, rent inflation has stopped falling and steady at 2.6%. For the last 30 years or so, rents have tracked population growth, and as Canada unwinds from the insane immigration policies, we were expecting rent inflation to fall even further. A look at market-based data confirms our intuition. This chart is from the website rentals.ca, and if this reality on the ground was properly reflected in the CPI data, it would drag down the entire CPI basket. What gives us confidence that inflation is in fact rising is the three preferred measures of core inflation, as defined by the Bank of Canada. They are all still trending higher. Keep this chart in mind next week during the Monetary Policy Press Conference when the BOC disavows these measures in order to focus on growth. These are measures that are specifically designed to show persistent underlying trend in inflation, and they are indeed rising. Something else to watch out for during the BOC presser is another reason we might be wrong about our view that inflation is heading higher, and that is inflation breadth, or the proportion of goods and services in an economy experiencing price increases, which indicates how widespread the inflation is across different sectors. The breadth of inflation pressures across CPI basket contracted slightly in September, although it does remain elevated and relatively widespread. Roughly 47% of components demonstrated annualized 3-month inflation rates exceeding 3%, but this is down from 50% in August. Another reason we are confident inflation is heading higher is the IceCap inflation model that continues to suggest that inflation will rise over the next coming months and quarters. But as you can see, the path is not a straight one. If the economy does contract and huge deficits are insufficient to offset falling aggregate demand, it's hard to see inflation rising from here, even if the loonie weakens further. So what does this all mean for the BOC? Well, despite being a single mandate central bank targeting inflation, the recent spout of weak economic data all but assures an October rate cut. This is a mistake. Inflation, as I've shared with you before, is rising and at the top of the Bank of Canada's inflation target range. Although there are reasons to be skeptical about that view, what's more important is that lower rates will not address any of Canada's underlying structural issues. Poor productivity, weak private capex, capital flight, a bloated bureaucracy, a record tax take, high debts, anti-oil regulation, and housing affordability. Negative real interest rates or monetary policy target that is below inflation is not the answer. They are in part the cause of Canada's problems, fueling malinvestment, siphoning capital away from non-residential investment, and entrenching inequality. Despite this, it seems like the Bank of Canada has not at all learned from their lesson, and we expect interest rates to be cut next week. We'll see what happens towards the end of the year. All right, that's a wrap on this week's episode. Thanks again for watching. As always, please like, subscribe, and follow for more. And we manage money for families all across Canada and the world, so please feel free to get in touch.